The bottom line of a bank. It starts with determining how you would actually calculate profitability. Most of it is done through your capital employed and your capital cost, but lots of it is also done through the operational cost. And how to calculate operational cost within a bank. Activity-based costing in banking is one of the most widely used methods to do so. And although it has a little bit of an old-fashioned ring to it, it's still very actual and it's still very alive, and there's a lot of sophistications going on in that field. I'll try to explain a few of them. Traditionally, activity-based costing, and that's still the case, is about thinking how you get from your cost that you probably have in your general ledger all the way down to your cost in your products or even your transactions. I get to that later. But getting that from your general ledger all the way down through a cause and effect level is what you would be aiming for in activity-based costing in banking. That goes through some different levels that you have. The most obvious one, if you have your cost in your general ledger, those costs are not there just because you like to have cost. That's because you have resources. Those resources could be personnel. That's most of your cost probably in a banking situation. But it also could be IT capacity, which is storage, which is computing, which is all different kind of elements that you have within your IT department. But it could also be infrastructure and anything that can be qualified as a resources. The resources are there within your premises, not so much because you'd like to have those resources, but those resources are there because they perform activities. And those activities are being performed to service clients or products, and these come all together. So this whole layering down from your general ledger to your resources, to your activities, to your products and clients, to your transactions, that is the basic premise of thinking about activity costing. And you want to layer that down all on a cause and effect basis. You just don't want to push cost through, but you really want to have drivers that are really recognizable within your company. Within a banking situation, you have a few certain easy to categorize types to being overhead or direct departments, relatively easy. Things like IT, finance, when it comes to HR, those are relatively easy to classify as overhead. When it comes to direct departments, the front office and mostly also the back office can be easily attributable to your product, service, or even your clients. That's not the difficult part. The difficult part lies with those like gray departments like Treasury or sometimes risk management, because they are working on both sides of it. They sometimes actually service the finance department, but they sometimes also service directly the front office or the back office. So these are always a little bit more difficult to allocate out. Especially with the data that is currently available at banks, it's not a very difficult premise to be doing. Having said that, doing it on a product level is actually something that we still see quite often, but that actually neglects all the other elements that are being captured in a transaction. If a mortgage is being bought, it has different elements to it. It doesn't only have like the type of mortgage, which would be the product, but it could also have the customer type, the channel through which it's caused, the region, there's a timestamp on it, there's pretty much information. So what we really advocate is to calculate cost not down to a product or a client level, but actually down to a transactional level. So every transaction that's being done, and the definition of transaction will be different for every bank out there, because sometimes you want to go really granular and you would have a look at even every different name change or address change. That might be a little bit too granular, but if that's what you need, then that's what you need. But the sort of purchase transaction where the loan is being closed or the account is being opened, those are elements that you really like to look into, because those transactions contain information that differ in operational cost. And if you want to calculate the bottom line of a bank, you want to know exactly what your operational costs are for your different products. And then you can actually set them against the revenue for your different products. And that's how you calculate the bottom line of a bank.